Hey, welcome everybody to another eye opener. This is Market Wealth Daily's quick little video chats that we do with top traders. We've got Keith Harwood here with us this morning. Keith, thank you for jumping on before the market opens. Looking like we have got one heck of a week lining up here. There are a lot of pieces at play, and we're going to be really interested to see what happens as this all plays out throughout the day. I mean, just crazy stuff. What are you looking at?
Yeah, I mean, I think as you mentioned that there's a big expectation of news this week. We've got tariff updates that are all coming in with resolutions, so maybe that's behind us finally, and then that can be less of a concern going forward. We've got mega tech earnings, Apple, Amazon, Microsoft. We've got a Fed meeting on Wednesday. We've got non-farm payrolls on Friday. So there's no, for those looking for an input, you're going to find one this week, whether it's a focus on tech trades, whether it's a focus on stuff related to the Fed, general economic conditions trades. There are a lot of fundamental inputs. So, for me right now, yeah, the market's at a brand new high, overbought here for the RSI. For those that don't recall or aren't familiar with the RSI, it gives an indication of effectively how large the up moves are versus how small the down moves are. So when you get an RSI above 70, it tells me that the market may be getting ahead of itself. It's not that it's bearish, it just means maybe we've rallied a little bit too fast and now time needs to catch up. But if it's coming with fundamental inputs like tariff updates or fundamental inputs like, generally good earnings, then it can be justified and we can actually continue to maintain that. Now, for broad market, we don't maintain it for long. Below 30, we don't maintain for long. We do tend to consolidate after that before getting a big rally. But, it could also just be a slowing of the rally or continuing to digest some of the inputs as they come in. So either way, broad backdrop is bullish. And unless something comes out, probably has to be just really terrible earnings from, Apple and Microsoft, or something with the economic conditions. More likely, it seems to be the non-farm payrolls than the Fed, because it's pretty much, written down that the Fed's not doing anything on Wednesday. So unless their verbiage is a little bit concerning, it seems like this market just has no reason to drop aggressively. And so we're looking for a continued grind up higher. And after,
Yeah.
from a technical perspective, we broke back above the previous highs. The initial breakout occurred when we got over 613.23 back in, about a month ago. And then we rallied and then we consolidated for a bit and then we started the rally again. So, I think of this as a potential for a stair step, or we could just be going back to what we did, for years, where we just, kind of just kept drifting higher and nothing ever seemed to get in our way until finally something did. And then drift higher, and then, we get a bad non-farm payroll number that gets concerned about stagflation. But then we just go back higher, and then tariffs. And ultimately, that was the best buying opportunity in 2 years. Or, if I was looking for a dip to buy back in February and said, finally, I got my dip, I just got back in where I would have been in February of 24. So for the long-term holder, you can see that the direction is up. It's just a matter of how big the dip is and how many days of rally we wipe out in that process, rather than turning it into a real buying opportunity relative to current prices. It may be a great buying opportunity relative to where we were a week or two ago. But overall, this market's bullish. And so I think we have to be focused on the bull side until the inputs tell us otherwise. And right now, there's not really an
Right.
input that tells us otherwise. So,
Yeah, quick question for you, right? So we're looking at the RSI, it gets into the oversold territory. It feels like this market's just got some bull energy behind it, but yet it is just grinding it out. That's the term that you used. I couldn't agree
yeah.
more. Just absolutely grinding that climb out. You feel like it's pulling some kind of downward pressure against it. It's fighting that to get up higher. And so, I look at, the tariffs and been trying to get my head around all that stuff. And there's so much speculation about how they're happening, how they're playing out. One of the theories is that there was this massive amount of buying in the beginning of the year of inventories and things like that, so that they could offset any potential tariffs and get a little bit more, like, retailers could get a little more and
That one's dead.
manufacturers, they get a little more stability. They knew kind of what their cost was going to be able to forecast a little bit better, and that's going to start to run out. And we're seeing the tariffs start to kind of uh, theoretically lock into where they're going to be. Uh,
Yeah.
is that something that is worth paying attention to, or do we just shut the noise out and look at the chart?
I think that there's certainly something to look at there, but frankly, there are guys out there that analyze that stuff a heck of a lot better than I do. I know that I'm good with the technicals, I'm good with the AI utilization, and I'm good with the options structure. And so, if the market is telling me that they're okay with that, then I have to just trust that they understand the risk and that they don't see it to be there. Now, I will say I also believe that when it comes to tariffs, if there was an impact from tariffs on earnings, the thing that fixes that is the expected future earnings that are being announced by some of these companies. So when they say, okay, well, tariffs had a negative impact last quarter, but now the tariffs are going down, we expect everything to be fine again. Well, then the market rewards it and says, all right, well, so we got through the bumps and the bruises for the last 3, 6 months, but now going forward, everything is fine. So, as long as companies aren't saying that the future is bleak, it gives hope and optimism to the bull. And so we look to the long-term potential and say, okay, well, it may not be completely cheap today relative to where it may be in a week, but a year from now, we expect higher prices given what we're seeing on the broad economic standpoint. So, it's timing versus long-term growth horizon. If I'm looking to raise some cash in the next 3 days to pay some bills or something, maybe I'm not, maybe I'm doing so with a 75 RSI. But if I'm looking
Mhm.
for a retirement account 25 years from now, I'm still happy to buy here, frankly. So
Right.
the timing and the term of your position, I think matters as much as anything else for this market.
If there's clearly the bulls are winning, the market's going up, right? But there is this kind of again this gravity to that bull market.
Mhm.
With that, looking back at my notes from all my Keith Harwood lessons that you've given me over the years, I see the money moving around within the market, the sector rotation, and uh, is there a way to kind of dive in and see it, what we're looking at with the S&P is kind of the bottom line net result of the market, right? So how do you spot where things are moving faster than others, and how do you see the stuff that's kind of pulling it down? Is there a way to kind of break that out?
Yeah, so for me, a lot of that just goes back to looking at individual ETFs and also some of the subsectors. So or some of the other sectors. So you got S&Ps broadly bullish, tech, big, one of the biggest factors in the growth of this market, very bullish, closing on highs yesterday. Small caps. I start looking at
Mhm.
small caps and say, oh, when are they going to start participating in this broad bull market? Because yes, it's higher, but every time we seem to get a rotation into small caps, which we saw, just a few days ago, that was the 23rd. Um, then immediately it pulls right back. We haven't broken out above the February 6th highs. So while everything else is above the February highs, small caps continue to lag. And some of the bigger elements of small caps include financials, which we've had a heavy focus on recently just because they've been working and they're a broad measure of the economy. And they made their new high on Monday, but then, faded a little bit. And then one of the other ones that's really been lagging is healthcare. So, you look at your Johnson and Johnsons, your Eli Lilly's, your United Healthcares. These are stocks that just aren't going up. So until the market starts to see true value in the healthcare sector, I'm avoiding it. Um, like I said, I can point it to like Johnson and Johnson as a prime example of maybe a starting sign there because they had really positive earnings and then rallied. But even in that, the market is hesitant to go heavily into healthcare. It's not exciting. It's not the dynamic growth sector. The dynamic growth is AI, it's tech, and if you're looking for economic exposure, it's financials. And I'll give you one step further on some of this sector analysis. When I go through the stock forecast toolbox, I look at it and say, okay, well, what do we see for the broad market here? And the S&P 500, right now, we've got a decent model grade at today's trend of 0.2%, pretty traditional here for the S&P 500 from what we've been seeing recently. And this long-term, 2-week out growth expectation. positive 3% potential for the next 2 weeks. That's a pretty good couple of weeks for the market. You get 3% every 2 weeks over the course of the year, you're going to have a 78% year. That's not going to happen, more than likely. I guess I shouldn't say not going to happen. It's just unlikely to happen. But that tells me that there is some money flow here, and the AI is picking up that money flow is there, is looking to accumulate positions for the broad market. But again, it's not an XLV. XLV, when I pull up that sector, it's choppy. Sure,
Mm.
projected to maybe go a little bit higher, but we're talking about a quarter or 0.5%, something like that over the next 2 weeks. There's nothing really giving that a lot of momentum. Even semiconductors not showing nearly the same potential strength as the broad market. So we're not going for, necessarily the NVIDIAs, AMDs, Microns, Intels, Texas Instruments, which just had poor earnings. On the recent note, we haven't seen that money flow there. Now that could shift today, it could shift tomorrow. If it's going to shift, it could just be off of some of these Mag 7 earnings. And actually, that's where we're seeing a lot of money flow right now heading into their earnings. So you could see Mag 7 being a decent participant here in this money flow. And the projection is that money flow could continue and maybe should. Now, I don't want to invest in the Mag 7 right now because, frankly, between Apple, Amazon, and Microsoft earnings this week in particular, I got a lot of exposure to fundamental inputs. And if one of them has a bad week, that could shift the
Too,
whole,
too much of a wild card. Yeah,
yeah.
definitely.
No, so I go back and I looked at too many ETFs this morning, and frankly, the one that I see that looks a lot like the broad market and is showing some bullish behavior continues to be financials. So
Mm.
it's a little bit
Yeah.
less than before. We're showing a little bit more chop here in that upside, but showing a good positive 3% vector, a nice upward trend, and it looks really solid. And last week we had talked through Citigroup in the
Mhm.
article I wrote, and Citigroup had a nice week. Not a home run per se, but from Tuesday and then Wednesday morning opened up, and it really did its pop Wednesday during the trading day, closing on the highs and then stabilizing for the last few days. Up small today. The August 15th 95 calls went from a buck 60 to 210. So 35% again, roughly. And, again, 30, yeah, I guess, yeah, 30%. So, okay, only 30% for the week. Oh, well. But Citigroup right now doesn't necessarily show that great momentum for the future after this period of consolidation. So within financials, the next week, Citigroup doesn't look that dynamic. Maybe afterwards it gets a pop, but I have less confidence in the late term of the vector than I do in the beginning term. So in a couple of days, if this plays out as expected, and then we start seeing bullish momentum, maybe I re-engage with Citigroup. But right now, there's other financials out there, and one of the ones that I actually really like right now was a name that had really positive earnings. It's a little different. It's Charles Schwab. So, the broker side of things. And this is that chart that I always like to show that I love to see. So when I'm looking for a stock, I want a stock that's showing a positive vector every day with potential for growth and a consistent, very dynamic rally. I don't want that choppy rally because it means that I'm going to have up days, down days, and I'm going to sweat a lot throughout that period. I'm going to get
Mhm.
less confidence because of a down day, even though that's hitting exactly what the model projected. Charles Schwab right now looks like a nice growth projection here. And when I go to their options chain, first thing to note here is that the implied volatility of Schwab is down to 6-month lows. So that means options are as cheap as they've been in 6 months.
Mm.
Second thing to note is they had positive earnings, which I don't know if I mentioned before. And that's a good baseline for them to say, okay, well, they had this nice rally, this long period of consolidation with a light bullish tint. Earnings came in and they beat, and everybody's happy about the way that they're looking. So the fundamental backdrop of Schwab is bullish. There's
Right.
still some exposure to any financial with the Fed or non-farm payrolls, but Schwab may be a little bit cushioned from that being more on the brokerage side as opposed to looking for pure, JP Morgan, Morgan Stanley, Bank of America type trades. And as we sit near the highs, it can be a little bit daunting to go out and buy some out of the money options or at the money options. But I give myself a little bit of time here and I say, okay, fine. I got time here if I go out to September. The 97.5 or even $100 calls are both interesting ideas. My projection for this next week is to get up to about $100. I probably go with the 97 and a halves in that case because I want to go away from or at least through my long strike when I'm getting into a long call position. So I get a little bit better setup overall from the 97 and a half call than the $100 call. $100 call is where I'm going to potentially target. I want to be above my strike when I'm exiting. So I go to the
Mhm.
97 and a half dollar call. It's $3.50, maybe up a little bit this morning. But if we go towards that projection of $100, even from 98 and a half, I can see a nice return on that. It's a 56 delta call, get $2 extra. That means I pick up a buck 10. And if the model's right, it's another 30%. And the more I can compound 30% returns in a bull market, the happier I'm going to be.
Yeah,
Maybe I get an
no, that
outlier every once in a while of 100% or something like that, or something crazy happens that drives this even higher. But, I think this is just a good, safer feeling setup than trying to, gamble with Apple or Microsoft for this week.
right. Yeah, no, nothing wrong with hearing the money making machine just humming along at 30%.
Yeah.
As long as it can make the turn on a relatively quick time frame. You're talking like a week, maybe a little bit longer at the most for what you're taking a look at here.
Yeah, yeah. Generally, I look for this for like about a week, and I say, okay, well, as we get towards, through the trade period, on Friday, if non-farm payrolls end up doing something that hits Schwab, then I'm going to have to reevaluate. Um, but if everything comes in kind of rosy or neutral and Schwab does what the model's projecting, um, great. I'll reevaluate on Monday, reevaluate on Tuesday. And then, for me, yeah, a week is a good target point for me because it allows me to get some appreciation from the directional move. I don't want to necessarily sit there and try to trade intraday because I do understand that as a former market maker, I'm giving a little bit of the edge to the market maker on this trade. So if I have to, instead of being able to get a mid-market execution, which in this case it's pretty tight, if I had to pay the offer and sell the bid, I'm already giving up 3% return.
Yeah.
Giving up a dime is giving up 3%. So for me to be willing to give up 3%, I need to make sure that I'm getting a higher return rate than an intraday scalping trade. I leave the scalping in
Got
the
it.
options for the market maker, and I do the little bit longer holding period to justify the trade.
Yeah, that looks really good. I mean, again, I love the predictability of it, the way that all of the data points, and there are a significant number of data points in the AI approach that you guys use.
Yeah.
I love kind of your gut instinct, kind of confirming the data.
Yeah.
That always gives a lot of confidence into the trade, especially with the amount of experience that you got going into this. But then to be able to look at that and say, hey, this could be 30 points in about a week. What does that work out to on a annual return and compounding that, 30 times 52? That's a pretty significant number. So
Right. Well,
I don't think
to note, obviously, I'm not looking to put 100% of my account into a single trade, but at the same point, if
right.
I can risk 5% of my capital into Schwab and I get 30%, that's a percent and a half with 95% of my money still in cash.
Yeah.
So, I have worst case scenario down 5% and best case scenario, I can keep building up that just small portion of my account over and over with 1.5% add-ons to my account. Or, if I put 10% in and set a stop, because I don't want to lose 10% on an individual trade. But that's also
Right.
part of why we go out to September because it's unlikely to lose the full premium, even if Schwab dips to $95 a share. There's still some premium left in those options, and I may take a loss, but it's not going to be nearly as significant as the full 100% loss that I never want to
Yeah.
experience.
Yeah, we could do about 100 of these all on the smart trading rules that you just gotta build every trade with that those kind of building blocks that you put in place and then look for that dial in the variables of that particular trade.
Yeah,
In these quick talks, we talk a lot more about that particular trades. I guess we do make a little bit of an assumption that the folks watching know kind of position sizing, asset allocation, diversification, all that stuff. But that might be something to bring up in a future discussion. We can kind of
yeah.
break those out and just hit some of the guidelines because we take it for granted. And even if you do know it, it's never a bad thing to go back and just kind of revisit that and make sure that you got your rules set correctly.
Yeah.
So yeah, just good stuff. But man, this is incredibly helpful. This is exactly what I was hoping for this morning.
Yeah, no, I'm happy to help here. And yeah, like you said, I mean, one of the things that I love about options is it helps me define the risk, but it also means that I'm not utilizing all my cash. I mean, so to that point, if I wanted to buy 100 shares of Schwab, it's going to cost me $10,000. If I want to buy one
Yeah.
call option that represents the ability, the option to buy 100 shares of stock, it costs me $350. That doesn't mean I'm going to go out and buy 30 of these calls for $10,000 and risk the whole boat. It means that I've now got my control at a much cheaper entry point, and maybe I want to buy two calls instead of 100 shares. But then I have other capital to deploy elsewhere. I can hedge. I can do anything I want with that free cash and look for other opportunities elsewhere in the market.
Yeah, now that is the beauty of options. And man, just I sound like an old man, but it has gotten so much easier to trade options in the last few years. So many tools, so many different ways to educate yourself so that you understand it. And there's different levels of option trading. You don't have to get into the incredibly complex stuff. I mean, just buying a call like we're looking at today, relatively simple. You can, within a very realistic amount of time, understand what you need to know to be able to do that wisely, execute that trade, and get a lot more than you would, to your point earlier, the illustration you made, than you would just buying the actual underlying stock. So, uh,
Absolutely.
wonderfully useful tool. This is awesome, Keith. Hey, thanks so much for jumping on. I know the market's going to open in a couple minutes here, and everybody's always anxious to keep an eye on that when they fire the starting gun, you know. So,
Of course.
but this has been really helpful. Appreciate it, and we'll definitely be keeping an eye on this trade and watching it throughout the week. And we'll be talking with you again next week.
Sounds great. Thank you again, John.